Welcome in. If you're joining us today, you're likely the type of person who isn't satisfied just, skimming the top line numbers of a press
Right,
release.
you want the actual mechanics underneath.
Exactly. You follow the aerospace and defense sector, and you want to get past all that surface level noise to figure out how the gears are actually turning.
Yeah.
And, that is exactly what we are going to do today in this deep dive.
Yeah, we have a rather complex puzzle to put together today. It requires looking at the data from quite a few different angles to really see the full picture.
We really do. So our focus for this deep dive is the brand new fiscal 2026 third quarter earnings report from Aerovironment.
Just dropped today.
Just dropped today, March 10th, 2026. And if you have been tracking this company, you know they are far beyond their legacy as just a drone manufacturer. I mean,
Wow.
they operate across air, land, sea, space, cyber.
The whole spectrum.
Right. They're building autonomous systems, directed energy weapons, advanced electronic warfare capabilities.
They're really positioning themselves right at the center of modern defense strategy. They're building the architecture for, as they put it, tomorrow's conflicts.
Tomorrow's conflicts, yeah.
But that level of ambition makes their financial reporting incredibly dense and, frankly, highly volatile.
Which brings us to a fascinating detail right at the top of their corporate branding. If you look at Aerovironment's official logo, they use the tagline, "Proceed with certainty."
Oh, the irony.
Right. When you read through the actual wild ride of these Q3 financials, certainty is probably the absolute last word that comes to mind.
Yeah, without a doubt.
Because we're looking at a central contradiction in this report. How does a company achieve a staggering 143% jump in quarterly revenue,
Massive jump.
while simultaneously reporting a massive net loss of $156.6 million?
It's jarring, seeing those two metrics just sit side by side in the exact same quarter.
It really is.
To understand how a defense contractor can have its best operational quarter on the top line, while taking just a brutal hit on the bottom line, we really have to pull apart where that revenue is actually coming from.
Okay, well, let's start with that top line boom. For the third quarter of fiscal 2026, Aerovironment brought in $408 million.
Wow.
Yeah, and in the exact same quarter last year, they were sitting at $167.6 million. Tripling your quarterly revenue year over year in the defense sector usually requires a massive catalyst.
And that catalyst was definitely the May 1st, 2025 acquisition of Blue Halo. We can see the immediate impact of that when we break the $408 million down into their two main reporting segments.
Right.
So their traditional powerhouse, which they categorize as Autonomous Systems, or XXS, pulled in a very solid $278.7 million.
Which is really healthy growth just on its own.
It is, but the real structural change is in their newly formed second segment.
The Space, Cyber, and Directed Energy segment, SCDE.
Exactly.
Yeah.
This segment didn't even exist in this capacity a year ago, and it brought in $129.3 million this quarter. And the report explicitly points to Blue Halo as the engine here. It noted that Blue Halo contributed $85.1 million in product revenue and another $91.4 million in service revenue just in the third quarter.
You know, looking at those Blue Halo numbers, the ratio between product and service revenue really stands out to me. Aerovironment's overall service revenue saw a $102.3 million increase this quarter.
Yeah, that's a huge pivot.
Right. It feels like a fundamental shift in their business model, moving away from purely shipping proprietary hardware and stepping heavily into the ongoing service and support side of defense contracting.
It completely changes the entire financial profile of the organization. Because think about it, when you sell a piece of hardware, it's a localized transaction.
You ship it, you book it.
Right. But when you take on a massive service contract, especially in something like cyber defense or ongoing space operations, you are embedding your personnel and your continuous support into the daily operations of the defense apparatus.
It's sticky.
Highly sticky, recurring revenue. But it behaves very differently on an income statement than selling a fleet of autonomous vehicles.
Okay, let's unpack this, because that shift to services seems to be the prime suspect when we look at the pressure on their margins this quarter.
Yes.
The top line revenue is exploding, obviously, but their gross margin percentage actually fell from 38% in the same quarter last year all the way down to 24%.
Yeah, though we should clarify for you listening that the actual gross margin dollars did increase.
Right.
They brought in $98.8 million in gross margin, which is a 56% increase year over year. So they are capturing more total dollars. But the percentage squeeze is a direct result of that evolving business mix.
Because integrating that much service revenue just inherently dilutes the high margins they typically enjoy on their proprietary hardware.
Inherently, yes. Massive government service contracts, particularly those bringing in hundreds of newly acquired personnel from BlueHalo, they just carry a different margin profile than selling established defense tech.
So as the service side of the business eats up a larger slice of the overall revenue pie, the blended margin percentage is naturally going to compress.
Exactly. But there is also a significant accounting factor eating into those margins that we need to mention. The report highlights non-cash purchase accounting expenses and intangible amortization.
Right, which took a $12.7 million bite out of their gross margin this quarter. Compare that to just a $3.7 million hit last year.
And that is the reality of digesting a multi-billion-dollar acquisition in the defense space.
Amortization is always a drag on paper.
It is. When Aerovironment bought BlueHalo, they were acquiring tangible assets, sure, but the real premium went toward intangible assets.
Proprietary algorithms, cleared engineering teams.
Specialized intellectual property, established contract vehicles, all of it. And accounting rules mandate that the cost of those intangible assets must be amortized over time.
So it shows up as a heavy expense on the income statement, dragging down the GAAP profitability, even though it doesn't represent cash currently walking out the door.
Exactly, it's a paper hit.
But a $12.7 million amortization expense, while it makes sense in the context of a massive merger, it doesn't come close to explaining the dark cloud hanging over this entire release.
No, it doesn't.
Here's where it gets really interesting. Despite generating $408 million in revenue, Aerovironment reported a loss from operations of $179 million and a final net loss for the quarter of $156.6 million.
Yeah, the trigger event for that massive loss is the absolute most critical piece of this entire earnings report.
It happened very abruptly, right?
Yeah.
January 2026.
Right, just weeks before the quarter closed.
So the report details a stop work order from the United States government. This was tied to an other transaction agreement for the delivery of Banjaraman phased array antenna systems,
which is a key component of the Space Force's SCAR program, the Satellite Communication Augmentation Resource.
Right, so the Space Force hits the pause button on the SCAR program.
And that created an immediate cascading effect on Aerovironment's balance sheet. See, when a company executes an acquisition like BlueHalo and establishes a completely new space segment, the carrying value of that segment on the balance sheet is heavily predicated on expected future cash flows from these major government programs.
So when the government suddenly halts a program like Badager, the foundational assumptions used to value that newly acquired segment are instantly invalidated.
Exactly. That stop work order acts as an accounting trigger event. It signaled that the carrying value of the entire space reporting unit now exceeded its actual fair value.
Because a massive expected revenue stream was indefinitely paused.
Right. Consequently, corporate accounting standards require the company to take a charge called an impairment of goodwill.
And the size of that charge is just staggering. Aerovironment had to write down the value of their space unit by $151.3 million in a single quarter.
Yeah, that single impairment charge instantly wiped out the operational profits generated by the $408 million in revenue. It drove the entire company deep into the red for the quarter.
It's a harsh reminder of the concentration risk involved when your primary customer is the federal government. A single administrative decision in Washington can erase 9 figures of balance sheet value overnight.
It's terrifying from an accounting perspective. But what stands out in the report is how Aerovironment's management is actually navigating that reality.
Right. They aren't shelving the Badger antenna system.
Not at all. The report states they're updating their long-term cash flow estimates to absorb the reduced government revenue, but they are actually increasing their expected research and development and capital investments into the Badger product.
So they're attempting a major strategic pivot here.
Yes. Since the custom government program is paused, they are opting to push the Badger technology toward broader commercialization instead.
Taking the financial blow now and choosing to self-fund the continued development.
Because the calculus is that a commercialized version might open up expanded long-term market opportunities that aren't solely reliant on a single Space Force contract.
It's a calculated bet on their own engineering, with the hope that it eventually yields better product margins down the line. But, for anyone tracking this stock or analyzing the company's health, it creates a very messy financial picture.
Extremely messy.
You have top-line growth of 143% masked by a $156 million net loss. How do investors make sense of that? How do you evaluate the actual operational health of the business through all that accounting noise?
Well, you have to look at the dual reporting metrics. The $156.6 million net loss is the GAAP reality, generally accepted accounting principles.
And GAAP numbers are uncompromising.
They are. They force the company to absorb the $151.3 million impairment hit and the heavy amortization for the Blue Halo intellectual property all at once.
Which is why management places heavy emphasis on their non-GAAP adjusted EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization. Adjusted EBITDA is how Wall Street attempts to strip out the one-time, non-cash distortions to find the operational heartbeat of the factory floor.
So when you remove that $151.3 million goodwill impairment, the heavy M&A amortization, and the tax implications?
Aerovironment actually generated a positive adjusted EBITDA of $44.5 million for the quarter.
And comparing that $44.5 million to the $21.8 million they generated in the same quarter last year paints a completely different picture.
It really does. But both sets of numbers are essential for a complete analysis. The GAAP net loss illustrates the brutal financial vulnerability of relying on major government defense contracts and the painful reality of digesting a massive acquisition.
Right.
But the non-GAAP adjusted EBITDA demonstrates that the core engine manufacturing autonomous systems, integrating cyber services, securing new contracts, is running significantly hotter and more profitably than it was 12 months ago.
And that core engine seems to be operating at an unprecedented capacity when we look at the forward-looking indicators. The metric that jumps off the page here for me is their funded backlog.
Oh, absolutely.
As of January 31st, 2026, Aerovironment's funded backlog reached a record $1.1 billion.
A $1.1 billion funded backlog represents firm orders where the customer has already appropriated the capital. It's locked in.
To put that trajectory into perspective, back in April of 2025, their backlog was sitting at $726.6 million.
So they have added hundreds of millions in guaranteed future work in under a year.
The velocity of that incoming work is captured in their book-to-bill ratio, too. They reported that at 1.6 for the first 9 months of the fiscal year.
For those listening, a 1.6 book-to-bill ratio is a massive operational indicator. It means that for every $1 of finished product or service they deliver and bill to a customer, their sales teams are simultaneously securing $1.60 in brand new orders.
Their pipeline is essentially writing checks 60% faster than their manufacturing base and service teams can cash them.
That kind of ratio puts immense pressure on a company's supply chain and hiring pipelines. You can really hear the focus on operational throughput in this statement from their CEO, Wahid Nawabi.
Right. He emphasized that the company is executing with discipline and actively scaling manufacturing ahead of demand.
He also projected that this backlog positions them for record fourth-quarter revenue and a solid start to fiscal year 2027.
Management is clearly trying to direct the market's attention past the Q3 impairment charge and toward the sheer volume of impending deliveries.
And that optimism is quantified in their updated full-year guidance for fiscal 2026. Because despite the massive impairment charge ensuring a severe GAAP net loss for the year, they're projecting full-year revenue to land between $1.85 billion and $1.95 billion.
That's huge.
Furthermore, they expect full-year non-GAAP adjusted EBITDA to remain highly profitable. They projected between $265 million and $285 million.
So they're projecting nearly $2 billion in revenue while navigating some very turbulent waters. But, the report does not shy away from outlining the specific risk factors that could derail that guidance.
The forward-looking statements in these defense sector reports are always illuminating. Aerovironment explicitly flags the ongoing operational challenge of integrating Blue Halo efficiently.
Because bolting on thousands of employees and a completely new cyber and space culture is a delicate process.
It's incredibly delicate. It can easily fracture if mismanaged.
They also heavily cite their reliance on U.S. government funding, pointing specifically to the threat of government shutdowns.
Yeah, when your backlog is dependent on appropriated federal dollars, congressional gridlock is an existential threat to your quarterly performance.
They also highlighted the increasing risk of potential security and cyber threats targeting their own internal systems or their extended supply chain.
Which makes sense. When a company is actively designing the architecture for tomorrow's conflicts, its own intellectual property and employee networks become high-value targets in today's digital battlespace.
It's the inherent paradox of being a top-tier defense technology provider. The more critical your systems become to national security, the larger the target on your own corporate infrastructure.
It really is.
So, Synthesizing all of this data from the March 2026 report for you listening, Aerovironment is a company experiencing extreme evolutionary friction.
That's a great way to put it.
They are successfully transforming their core identity by digesting Blue Halo, which has massively expanded their capabilities into space and cyber while unlocking highly lucrative recurring service revenue. They are managing a staggering $1.1 billion backlog and securing new orders at a blistering pace.
Yet they are simultaneously absorbing the harsh volatility of the defense procurement environment. A $151 million impairment charge triggered by a single Space Force pause on the SCAR program wiped out an otherwise historic quarter on paper. It's a stark example of how fragile the balance sheet can be during a period of rapid acquisition-fueled expansion.
It really leaves you with a critical dynamic to ponder regarding the broader defense technology sector. The report starkly illustrates how heavily these innovators rely on the U.S. government, not just for revenue, but for the fundamental R&D funding that drives next-generation capabilities.
Very true.
If a sudden stop work order on a single antenna system can instantly erase $151 million of value from a private company's ledger, it highlights the immense invisible power the federal defense budget wields over the pace of private sector innovation.
It dictates everything.
Right. As these companies scale rapidly and acquire massive new capabilities to prepare for future conflicts, there is a constant tension regarding who actually absorbs the financial risk of building the future.
Is it the private defense contractors who have to swallow massive impairment charges when priorities shift?
Or is it ultimately the taxpayers funding the underlying demand? The Aerovironment Q3 report puts that delicate, high-stakes ecosystem right under the microscope.
It's a dynamic that will absolutely continue to define the financial reality for every major player in the aerospace and defense sector moving forward.
It really will. Thank you for joining us today and bringing your curiosity to the table. Keep looking past the headlines, keep analyzing the data, and we will catch you on the next deep dive.